You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Before we begin today, I want to remind you that there is a website associated with this podcast. It's called wealthformula.com. That's where you can sign up for a number of our resources, including our accredited investor club. Our investor club is in business. We're getting ready to launch a few things in the next few weeks here. So make sure you get on the list if you are an accredited investor. What that means is you make $200,000 a year, at least as an individual. You've been making that for a couple of years and anticipate continuing to do so, or $300,000 if you are filing jointly, or you have $1 million outside net worth outside of your personal residence. Anyway, if you meet those criteria and are interested in potentially seeing some deal flow, get onboarded by going to wealthformula.com and investing on Investor Club. Anyway, let's talk a little bit today about, investing, right? This is what this show's all about. It's about personal finance. And, I wanted to, I've been going back to some basic topics lately in this back to school series. I'm going to have another one this week as well. But today we're going to talk to Zulfe Ali. Now, Zulfe's a broker dealer and investment advisor, but he's not your run-of-the-mill type in this field. He's been in the middle of the action on Wall Street as a mergers and acquisitions guy for JP Morgan and Bank of America in the 90s. He's worked in private equity. He's ran a multi-billion-dollar sovereign wealth fund as the chief investment officer. He did that over a decade. I've seen photos of him with world leaders like UK Prime Minister Tony Blair, former Prime Minister Tony Blair, and others as part of his position. And to say the least, he's not one of those 6-week course advisor types out there. And he has now opened his doors to individual investors like us. And he's using institutional principles to help clients grow their money. Now, as you can imagine, those principles are quite different from your typical advisor. And I'm happy to endorse him to anyone looking for a third-party financial advisor. People have asked me for a recommendation throughout the years on this, and I've not been able to give one until now. Now, again, I don't actually use a financial advisor myself because I am, I am kind of hard-headed and very clear about what it is that I want to do. But then again, that's my full-time gig, right? That's what I'm doing all the time. And you might have a job and you might be busy and want somebody to help you with that. So that's certainly an option. Now, in this episode of Wealth Formula Podcast, I'm going to speak to Zulfe about his perspective on asset allocation and the current economy. So make sure to tune in after these messages. And one more thing, again, I am later on this week going to do another one of these back to school episodes. And then this is sort of kind of coming off of this episode, which is kind of funny, which is, Zulfe and his higher institutional level asset allocation information. But later on in the week, I'm going to give you a back to school episode where I just give you a little insight into how I design my own investment portfolio. It's kind of one of those things, don't do this at home kind of things. But, a lot of people have asked me the way I think about things. And so I'm going to do that. So look for that episode of Back to School later on in the week. But for now, let's talk to I guess one of the parents in the room, Zulfe Ali, after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Zulfe Ali. Now, Zulfe is an investment and capital markets professional with over 25 years of experience in an institutional setting with global financial firms. He started his career in the 1990s on Wall Street, working with a boutique investment bank in San Francisco, where he advised international investment companies on their investments in the U.S. across technology, biotech, and consumer sectors. He then continued his career in investment banking for 15 years at global banks in New York and London, such as Bank of America and JP Morgan, while focusing on a variety of activities, including IPOs, corporate mergers, leveraged buyouts, high yield bonds, and leveraged loans. After that, he got recruited into a sovereign wealth fund in the Middle East as the chief investment officer, and ran that fund for several years before coming back to the U.S. Zulfe, welcome to Wealth Formula Podcast.
Thanks, Buck. Great to join you.
So, yeah, this is obviously a huge background in finance, and I appreciate you being part of the show, and also as we'll get into a bit, a partnership on the side of helping us with a broker dealer and an RIA that is actually associated now, associated in the sense of just being able to help some of our investors guide this kind of confusing time and place in history here. But before we do that, why don't you, we've talked a little bit about your background. There's some big stuff here, M&A, big banks, JP Morgan, sovereign wealth funds. Tell me what are some of the things that you learned throughout this time that people who are in the retail investing space don't really think about? And, what are some of those really key takeaways when you look at, institutional investing and, ultra high net worth individuals investing? What do they do differently than people who are on the retail side usually?
Yeah, I think the first area is the level of diligence. Frankly, a retail investor is probably not equipped and doesn't have the time to really spend the time that is necessary to diligence an investment opportunity. And by diligence, it's a word that gets thrown out there a lot, but I don't think people understand what that necessarily means. So, for example, as a broker dealer, when I'm leading a offering through the broker dealer, I have requirements that the regulators, the SEC, in fact, imposes that I undertake. And that is a full diligence of the issuer company. And that's everything from, diligencing their business, their owners of that company, the management team of that company. So we're talking about background checks, criminal checks. We do business diligence in the sense that we're vetting their assumptions, historical performance, making sure that what they have represented is accurate and is not overstated or does not omit material facts. We go into legal issues, legal liabilities, any kind of pending litigation, environmental issues that companies might face. There's just this very, I think, detailed process that an institutional investor in general will undertake. And the resources there, again, are different in the sense that, if a retail investor gets an opportunity to invest in a deal, they get an offering memorandum and go ahead and read it. When I get involved in leading that type of a deal, I'm in direct contact with that issuer. So the management team, the founder, I call their suppliers. I'll call people that they say that they have a material contract with, and I'll validate that. So third-party validation. I'll check independent research to make sure their assumptions on their financial modeling is in line with what the industry or experts believe in. So there's a whole spectrum of diligence that has to be done that any typical institutional investor is going to do, and that is very, very much in line with what a broker dealer is also required to do in that process.
So I think one of the lessons here, at least for me during this period, because we saw some pretty bad stuff go down during this space. When the economy is not great, sometimes that's when you see who's actually kind of fraudulent things sort of come to light and that kind of thing. And in this podcast ecosystem, we saw a handful of things that really went down, which were really unfortunate, including various type of Ponzi schemes and all that kind of stuff.
Yeah.
And obviously, I mean, what do you think went wrong? I mean, in those types of situations, because I know some of these people, and they're not criminals. They were raising capital for things, but I think they just,
Yeah.
what do
Well,
you think they got wrong?
that's the issue, right, Buck, is that, you have well-meaning, well-intentioned intermediaries who aren't, they're just not doing the work, right? So I think that's fundamentally the issue. I mean, when I
Or they may
engage
not
with
be
you.
sophisticated enough to do the work, right? I mean, I think that's a
Well,
big
I think that goes hand in hand. So I think there's a level of sophistication to not even understand that certain work needs to be done. So that's part A. Part B, when they do understand work that needs to be done, do they know how to undertake that work and to get it done to the extent that they need to get it done? I mean, the stuff that I heard recently that were such disaster stories, it seemed like at least one or two of them were pretty obviously uncoverable, in the sense that there was one operator that no one got a chance to see their facilities or their operations because they kept everyone out, for example. So I think there is sophistication, there is a lack of sophistication in those situations, resources, time. The best meaningful person can still get themselves involved in a situation that ends up going belly up if they don't do the work, and I think that's the issue.
Yeah, I mean, and frankly, that's why we've kind of added this additional layer or partnership we want to cost, whatever you want to call it, where, at the end of the day, I saw what was happening out there, and I want to make sure that anybody, in our group, obviously a lot of it is real estate. Real estate is a little bit easier to digest, right? Like, you have a big
Yeah.
building there, you're buying that, and there may be some additional value, obviously, even there too, and having somebody take a look at assumptions, underwriting, things like that in any given deal. But especially on things that are involved with business type things, I think it's
Yeah.
it's really challenging. I think, for me personally, it's not probably a strength. And so, in addition to look at individual businesses necessarily and decide whether or not they're worth investing in. So in order to bring that to our group, we've engaged with you on that front, and that's hopefully going to be very helpful. Now, I want to switch a little bit over to the other part of your business. Now, the business is called Valerity. Explain the difference between
Yeah.
Valerity, it's a broker dealer, and then Valerity as
Yeah.
as
They're
an
two
RIA.
they're two separate entities. They have different functions. They're registered independently with the regulators. So the one we've been discussing, Valerity Group, is a broker dealer, SEC registered, FINRA member broker dealer. As I mentioned, what the function there is really to raise capital for issuers, and so that could be a real estate company, that could be a private equity type company investment. It could be a fund.
Right.
So
You just
basically,
did, you just completed a big round of due diligence on the ATM fund, for example, and that was one that a lot of
right.
people wanted to see have significant due diligence done on. So that would be an example.
That's an example. That's an example where I've gone in, met the management team, gone through their financials, background checks, legal entity checks, talking to the regulator that regulates that business, all that kind of stuff that you would be required to do. And so that's an example of what the broker dealer does. So yes, it represents the issuer in the sense that we want to make sure as a broker dealer that the issuer is presenting themselves in an accurate way. If there's anything missing, omitted, non-factual, that gets flushed out and that gets disclosed to the investor. And then when I'm engaging with the investor, the SEC actually says that I have a fiduciary responsibility to the investor. So I have to make sure that it is a suitable investment for the investor, and that everything that needs to be done has been done from my side from a diligence perspective before I can recommend it to an investor. So, I've got responsibilities on both the issuer and the investor as a broker dealer, and that's regulated to be that way. The other business you mentioned, the RIA, which stands for Registered Investment Advisor, that is a business called Valerity Wealth. And there it is a business to help investors with their investment strategies, to help them develop investment plans, asset allocation, financial plans. And so that's working with high net individuals, accredited investors, family offices, in some cases, even some small businesses where, we develop a strategy based on that entity or that individual's particular situation, what their objectives are from a financial perspective, and then developing a plan, an investment strategy, an asset allocation model, all of that's suitable and tries to achieve the goals of that individual or entity.
So where you're coming at this is an interesting, from an interesting perspective, because you've worked for major banks, JP Morgan, Bank of America. You've been through a huge acquisitions, M&As, and then you run a sovereign wealth fund. What do you take, like, philosophically from those experiences? I mean, obviously you're going to be different from a guy who comes out doing 6 months and gets an RIA. Know what I mean? Like, so what do you take from those, like, experiences of really kind of, massive investment responsibilities, and how can you apply that to retail investing?
Well, listen, I think the beauty of it is that, when I look at the approach that we took at the Sovereign Wealth Fund, right? Sovereign Wealth Fund can be considered a big family office, to be quite frank, right? So it's got its own assets, it's got its own liabilities, it's got its own cash flow needs. There's certain objectives that they're trying to achieve. Some of them are financial, some of them are non-financial. And so you're looking at, across the globe and across all the different asset classes, how do you construct an investment strategy that optimizes what you're trying to address with that sovereign wealth fund? And so you can actually then apply that same approach to individuals. You don't have to be a sovereign wealth fund to get the benefit of that approach. You can be an accredited investor and have an advisor with the appropriate toolkit look at all the different asset classes that are available for you, look at an investment strategy that is comprehensive. If you're an investor that is particularly interested in real estate or alternative assets, to be able to help vet some of those investment opportunities, to build a portfolio that is complementary to those asset classes, right? And so there's a lot of synergies. I think, the differences will be size of investment, so that can limit certain asset classes or how you can get access to certain asset classes. It might limit, the type of fees you pay. Very, very large institutions are able to really push down fees and negotiate hard on a one-on-one basis. Retail investors will end up paying a bit more, but again, there's gives and puts. The institutional side, very large investors, they actually have asset classes that they cannot really invest in because they're too big and they move the markets too much. And that's where the retail investor has a benefit, right?
And they can't buy ATM machines.
Sure. Or you could even argue that, earlier stage when the multifamily residential industry was taking off, it's not an industry that really lent itself to institutional investors. It's getting there now. And institutional investors become kind of a good buyer of portfolios, but that's another example. I think that is particularly tuned to retail and high net worth individuals.
So, my one of the reasons I thought that your service on the RIA side might be of value to my listeners is because at the end of the day, like, listen, I'm very aggressive and I'm very, I'm very opinionated, and I know what I want to do with my money, right?
Yeah.
Not everybody is that way, and that's fine. It's, personal finance is personal, but at the end of the day, there's people who want help.
Yeah.
And what I have been trying to avoid for years is sending them to somebody who's just going to like tell them to do things because it's going to help them with their own retirement, frankly, from an AUM perspective.
Yeah.
I think, and I obviously, given your background and what you're doing and what you've done, you're somebody I'm trusting with my group here. Tell us, from that perspective, like, what if somebody comes into you right now and says, hey, I listened to Buck and I don't want to be a 90% real estate like him.
Yeah.
But what's a reasonable thing to do? Like, where do you start? Like, how do you start to look at it from a portfolio that's not just a boring portfolio, like that you're just buying ETFs and hoping and wishing, and like, how would you break it down differently than some of these other individuals?
Yeah, I think the fact of the matter is the vast majority of the advisor industry is coming from platforms where the primary product has been public equities and fixed income, right? And they don't know anything else. And so either you're in a 60-40 portfolio or an 80-20 portfolio, and that's kind of the extent of it, and that's by design. What I'd like to be able to bring to investors is much more flexibility than that, right? And listen, there are going to be situations where, depending on an individual's financial situation, that a large allocation to very safe government securities is going to be the right answer. But if you're looking for long-term growth and you want to have a diversified approach, then what I'm able to bring to my clients is an alternative, a good mix of alternatives. And that's not just real estate. It's going to include private equity. It's going to include other asset classes. We're developing and we have partnerships with operators in lots of different asset classes. There's a platform that is doing roll-ups on the private equity side. There is a partner that is working on aircraft purchases that they then lease out to airlines. So there's a slew of different asset classes. The benefit there is that diversification should continue to give good performance and enhance your returns, and at the same time mitigate risks. And that's really the rainbow that we're after, is that by including alternative assets to your portfolio, that you're gonna enhance your returns as well as mitigate your downside risk, just from diversification perspective.
And certainly, considerations, I think, of tax benefits and all that. I mean, you have a broader perspective on some of those things as well, and resources as well, right?
Yeah, that's right. And again, I think going back to your question as to some of the differences between, when you're at a sovereign wealth fund investing versus, working with individuals and family offices, the tax side of it is probably the biggest difference, right? There are structural and tax related benefits that individual investors can take advantage of that institutions cannot take advantage of, and so that also leads to opportunities that I think can be optimized. And we do have, as part of our registered investment advisor, Valerity Wealth, we do have an in-house tax expert as well that will work with individuals.
Yeah. Okay, so let's shift into what's going on in the economy now. Obviously, unparalleled times. We go through COVID, huge amounts of money printing. huge amounts of the availability of cheap money.
Yeah.
The market's going crazy, real estate market's going crazy, everything's frothy. Now interest rates go up at sort of I think from the perspective of the rate of increase, I don't think it's ever been this high.
Yeah.
Historically. And then inflation seems to be cooling down. What's your take on where we're at and where we're headed?
Yeah, I mean, I echo your sentiment there. It has been an extremely confusing market. Like you said, if we were sitting back here in March of 2022 and someone told us we're going to have 11 rate hikes in the next 18 months, we would have pretty much assumed the economy would be cracked, we'd be in a recession, unemployment would have spiked, housing market destroyed. But here we are, right? The GDP growth has been strong. Second quarter was, above, 2%. It looks like third quarter is on even a healthier clip than that. Unemployment is still low, around 4%. And then we've got, high housing market, which is holding relatively well. There's some dysfunction in terms of supply demand, but the demand is there, and it's healthy. And then corporates are doing well too, despite labor shortages, despite increasing labor costs, despite supply chain disruptions, increased financing costs. Corporates are doing pretty good, better than expected. Second quarter earnings came in better than Wall Street had been projected, and now there's been a bunch of revisions that third quarter is going to be better from there. So, the question I think is how is this possible? I'm not an economist, Buck, but here it goes. I mean, I actually think the short answer is the consumer. The consumer has driven the strength in the economy. The consumer, as you mentioned, got a huge amount of subsidies during COVID. They came out with $2 trillion of, cash subsidies from the government, and an extremely favorable job environment. There's data out there that suggests that the consumer has worked through about 2/3 of that stockpile of cash. So still sitting on, $600 plus $billion on their balance sheets. From that subsidy era. The job market still remains favorable. Labor markets are still tight. Wages are increasing, and by the way, wages are increasing ahead of inflation. So that's also quite
a problem. I mean,
quite a problem in the long term. But I think from a strength of the economy, it's continuing to boost the economy. So at the end of the day, the consumer represents 70% of GDP. Sometimes I think we forget that it is a major driver of our economy, and the consumer has been healthy and employed and out there spending. So I think that's really what's been going on, from the health that we see in the economy. I think the Fed is pretty much where it wants to be at this moment. Inflation has been moderating. It was up, I think 3.2% in July. We'll get another reading in, I think next week, we'll get the next inflation reading. Job market has been moderating a bit. You've got unemployment now kind of coming close to 4% from 3%. You've got more labor participation, which also signals that people are out there trying to get jobs. So that's good. Consumers, but the consumer is still spending, and even that is moderating. So net, I think, it's pretty, I think understood. The Fed is in a bit of a waiting mode. They're waiting for more data. The next meeting is September. I don't think anybody expects them to hike. I think November, maybe they hike, or maybe they push it off till December. I think the data is going to be the big question mark. And they'll stick in this kind of restrictive stance that they are with Fed rates at 5.5. Maybe it'll go a little higher. But I think that's probably what to forecast. Is you should just assume we're going to be in a higher rate environment for the foreseeable time period. I know there's expectations that the Fed's going to start cutting in 2024, but that I personally think that's wishful thinking. I don't think that we're going to have seen inflation tamed, and I don't think the economy is going to cool off that significantly for that reversal from the Fed at that point.
I tend to agree. I would love to see rates go down, but it's hard to imagine with this level of employment that
Yeah.
that
And
inflation is
listen,
going to cool that much. I mean, I hope I'm wrong. I hope it comes back and inflation's less than 2% and they put the brakes on. But I mean, it's funny. It's tricky because from where I sit, it's also very, very confusing because the real estate market has been hit harder in the sense that multifamily or commercial or whatever, anything that revolves around interest rates has been generally, there's been more pain there.
Well, and again, you're talking from a capital or financing structure perspective, right? Because I think rental rates still attractive.
They're doing great. They're doing great. We're still raising rents. We're still, we're still raising rents and all that stuff. But it's curious to see how that all comes to a head. And I guess no one really knows. You say you're not an economist. I've interviewed several economists who say the opposite of each other. So it doesn't really matter. At the end of the day, the question is based on the volatility or inability to predict the future,
Yeah.
Yogi Berra's quote about, it's hard to predict anything, especially about the future.
Yeah.
Right?
Well, listen, I like that quote. I do think that volatility in rates is probably the big part of it's probably behind us. And I think the assumption should be that we're in a higher interest rate environment for the foreseeable future, right? And I think
it's actually not at high historically. I mean,
and that's the point. Right. That's an important point. I mean, you don't have to go back that far. You can go back to early 2000s, and you'll find that mortgage rates are pretty much where we are today, right? And so that's low 7%, 7.5%, that kind of range. And we had a healthy real estate environment back in the early 2000s as well. So I think it's basically a need for the financing strategies of these businesses, of these acquisitions. I think those need to get addressed. Mm-hmm. But the underlying businesses seem like they're doing just fine, right? So I think that I think the question is, will operators kind of muddle through, patch up their cap structures however they can, keep pushing out, and at some point rates come down a little bit, and then they're out of the woods, and they can continue on. That's a possibility. I think operators that are significantly in trouble, my guess is, there'll be some wholesale portfolio sales, and those will likely go out to other institutions and larger investors. I actually think, my view is that it's going to be not likely that you're going to see lots of distressed opportunities coming to the market. I don't, we didn't see it in the equity markets. People have been waiting for a downturn in the equity markets. Hasn't happened. The market's up 20% this year. I don't necessarily think you're going to see that type of a distress situation in certain sectors of the real estate market. I think
there is distress for sure, but I think your point is well taken that may not necessarily reach the retail investor, right? Like so when you have these large operators that are having trouble, it's not the retail guys who are going to come in and sweep in. That is going to be corrected by larger institutions and REITs, things like that. And I should say, on the other hand of that, on the other side of that, because there is a lot of sort of stuff behind the curtain. There is sort of this institutional partnership level distress happens as well, right? Like, for example, an asset itself may not be distressed. It may actually be a cash flowing asset, but it might be a REIT that has capital needs, and so they're
Yeah.
willing to sell at a loss, and that's where we might be able to capitalize on a few things just based on some partnerships.
I think those are the ones that you want to be really proactive on, Buck. I think when you have a business, whether it's a real estate, whether it's an operating business that is doing well, doing everything that it said it was going to, but yet there are structural reasons why a seller needs out. Those are the ones you want to really move fast on, because I think those are attractive. They're tested, and just a matter of changing ownership to the right set of owners.
What so in terms of your clients now, you're so how are you positioning them in general? Like, are you are you positioning them just sort of I guess with a template that says, okay, this is a fairly we're just going to assume that rates are going to be around where they are, and we are going to buy with the new normal? Are you telling them, hey, don't buy anything right now? I mean, what's the obviously it's investor specific, but
it is investor specific. And so if somebody needs cash in the next year or two, I think there's an opportunity in the fixed income market on a 2-year government treasury that pays 5%, no risk, and you're going to keep your capital. You'll be a little bit ahead of inflation, and there you go, and there's nothing to it. But I think for investors that are in it for long-term growth, again, it's going to differ investor to investor what their objectives are and what their situation is. But my own recommendation is not to sit out this market at this point. I think there's more risk to sitting it out than to be deployed. I think you're going to have surprises in terms of a economy that is going to continue to perform well. The major risk, I think, is that it performs a little too well, and that we need to take interest rates up again. But I don't think that would be in the magnitude or severity that or anywhere near what the Fed has done. So if they bump up the Fed rate by another 25 basis points, 50 basis points, you probably won't see a lot of impact in overall credit environment. But that'll just be a little bit more restrictive, and if that's what the Fed needs to do to make sure that inflation keeps in control, keeps in check, and that we're heading for a bit of a softness in the economy, I think that being deployed now, you can ride through that. And again, if you've got a longer term perspective, you want to have 3, 5, 7 year type of horizons, investment horizons. And I think you'll come out fine. I do think there is a risk if you sit out now, that the market's going to move away from you, and you'll end up chasing it, and that can be quite damaging to your portfolios in the longer term.
Well, listen, this has been good stuff, and we could keep going on for a while, and hopefully we can sort of have an ongoing discussion. I think our investors could use your global perspective on things, and with that, by the way, I want to make sure that people know how to get a hold of you. Now, first of all, the broker dealer that Zulfe has is going to be pretty much doing most of what we do through Investor Club from now on. So if you are an accredited investor, make sure to reach out to his broker dealer. How do you get how do you reach you through the broker dealer?
Yeah, the broker dealer, simplest way will be to just email me. That's Zulfe, ZULFE .ali at veleritygroup.com, and it's VELERITY, veleritygroup.com.
Yeah, and if somebody needs clarification on that, certainly shoot me an email, buck@wealthformula.com, and I'll connect you. Also, as I mentioned before, there's been a lot of people over the last few years who've wanted additional direction in terms of just overall investing. And that's where Valerity Wealth comes in, valeritywealth.com. Again, I guess you just email you or go to the website, and there's probably a contact form there.
Yeah, exactly. There is a contact form at valeritywealth.com. Or if you want to email me, it's just Zulfe, Zulfe, at valeritywealth.com.
Fantastic. Well, thank you, Zulfe, and I'm looking forward to having you on as sort of a regular over time, so we can start, kind of getting your global perspective on everything. It's good to have you on Wealth Formula Podcast, and thanks for being on.
Thank you, Buck. Great to be here.
You're right back. Welcome back to the show, everyone. Hope you enjoyed it. And again, if you want to get in touch with Zulfe, make sure you go check out his websites and get in contact. Now, next episode is actually only going to be a couple days away. It's on Wednesday, and that show is actually going to be sort of my take on personal finance. Now, I don't want people to think that I'm advocating for doing things the way that I am. There's reasons that I do things the way I do. And part of that is that I have, this is what I kind of do for a living, right? So I don't really want people to say, well, he's advocating for a certain type of investing, because, the way I do things, I'm heavily bent into certain areas, and that's not for everyone. It might be for you, but I want to at least tell you what I'm thinking about. And so that's what we're going to do next week. That's it for me on this episode of Wealth Formula Podcast, though. This is Buck Joffrey signing out.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.